This week, Bill Ackman publicly announced his $900 million position in which he recently made in Starbucks. With that, he wrote a letter to his shareholders through his company, Pershing Square, where he talks about his rationale as to why he did buy this company. Now, what you have to know about Bill Ackman is he has a notorious record for being an activist investor. Activist investors are typically those that buy companies in which they believe there needs to be some fundamental change to. In other words, they see a company that's undervalued and that is managed inappropriately. However, contrast to his usual activist investor fashion, his rationale in investing in Starbucks is actually one of more fundamental and value-based. He reiterates this to his shareholders when he says he sees the company that has strong fundamentals, a healthy balance sheet, and is undervalued. We personally did a video on Starbucks not too long ago, and a lot of the things Bill Ackman covers, we covered as well, particularly being a stagnant stock price, increasing store count, as well as the growth story in China, which is a huge catalyst for the company. We did read the 44-slide document he read to his shareholders, so here are some important things he also talks about. He talks about Starbucks' ability to provide long-term shareholder return. More specifically, he looks at a decade period from 2008 to present day, in which he says, including dividends, Starbucks has doubled the annual return of the S&P 500. He says that although the stock price has been somewhat stagnant in the last 3 years, the company is in a much better position today than it was 3 years ago. They've added to their balance sheet, whether it be through taking advantage of tax policy or with good acquisitions and divestitures of their brand. For example, their acquisition of East China JV, their sale of the CPG business to Nestle for $7.2 billion, and the closing of the Tijuana stores and divestiture of the Tazo tea brand to Unilever. And with this additional money, whether it be from tax policy or from the selling of key parts of their business, they've announced a strong repurchase buyback plan. Just this year, management has quoted as saying they plan to repurchase $14 billion in shares, which is roughly 20% of their market cap. Bill Ackman also considers the PE of Starbucks, which is at 22 times earnings and much less to what the company has traded at historically. Recent historical averages show Starbucks to be trading at about a 26 times PE ratio. He sees them as relatively undervalued. He also likes the business's ability to generate a high return on invested capital. In other words, when Starbucks invests money into opening a new store, the return they get on those stores tends to be higher than the average in the so-called food industry. One of the main reasons for this is because Starbucks is in absence of a kitchen, and the absence of a kitchen in their stores lower upfront costs to open it up, as well as lower maintenance costs. He mentions that Starbucks is aligned with the health and wellness trends. On a global scale, coffee is increasingly becoming more in demand. We mentioned in our previous video the millennial generation in China in particular resonating with coffee consumption. Coffee consumption is increasing, whereas once it was considered only a beverage for the mornings, more people are consuming coffee throughout the day, including at lunch and dinner time. And with this, he provides some data on the strategic investment in coffee-related brands and coffee-related acquisitions. Since 2012, there has been $100 billion in coffee-related acquisitions. The valuations on these coffee-related acquisitions, when combined together, are at 20% larger than what Starbucks now trades. The measurement for this being TEV, or total enterprise value, over EBITDA, or earnings before interest, taxation, depreciation, and amortization. When discussing market share, Bill Ackman mentions Starbucks' dominance, especially in the US and in China, where they are 15 times larger than the number 2 player and over 3.5 times larger than the rest of the top 10 combined. He talks about a strong same-store sales growth track record on a long-term trend, which has somewhat slowed down recently, but is still booming and robust in the international markets. And when looking at other qualitative factors, what also is mentioned is Starbucks being well insulated from wage pressures in the United States, because Starbucks on average already pays above minimum wage in all 50 states of the United States. So is Starbucks a buy? Well, Bill Ackman certainly does think so. The key drivers in the stock's weakness in the last few years has been the slowdown in US same-store sales as of late, as well as reduction in long-term growth forecasts, readjustments as to exactly what kind of figure they can expect. And the most important thing in my opinion is the leadership transition and management turnover. He talks about this in a broad perspective, but I think in particular it relies to Howard Schultz stepping down and Kevin Johnson taking over. Howard Schultz is obviously well known for being a great CEO and his vision in bringing Starbucks up from the ground. And the vision shareholders have in a certain CEO often reflects in the stock price and the behavior around the stock price. Not to take anything away from Kevin Johnson, I just believe he's untested, whereas there's a certain level of admiration towards Howard Schultz. And in some ways, this kind of reiterates what we said, in that there has to be a certain level of patience if you're going to be owning this stock. And another major catalyst that one has to wait for to see how it plays out is their growth story in China. China obviously can be the major difference between their stock shooting up or stagnating, given the sheer vast numbers that are associated with the business going on in that country. We want to thank you guys for listening, and once again, happy investing.